Stock futures opened slightly higher Tuesday evening after the selling during the regular trading session, even after a report showed a slower than expected rise in inflation last month. The selling continued in September. The Labor Department's Consumer Price Index, excluding volatile food and energy prices, ticked up by just 0.1% in August compared to July, posting its slowest monthly gain since February. But what would you expect if you take out the volatile items from the CPI? However, the slower than expected rise in CPI helps the Federal Reserve's view that inflation will ultimately prove transitory and offers more room for the Fed to keep current monetary policies in place for longer. But let's you and me not make the mistake of falling for that charade. Let's be clear. There is and will be higher inflation than they will ever admit to. Just take a bit of time and research how CPI is calculated. If you do, you will find out that the estimate is so contorted, there is no reality or use for their estimate. But that's a video for another day. Forget CPI. There's still plenty of risk in the economic and equity outlook, and with the U.S. equities still relatively close to all-time highs, and the S&P 500 still up by more than 18% so far this year, don't let your guard down based on some flimsy Fed number. Supply chains are still stretched. Semiconductors are a problem across almost every industry, and labor costs continue to be a problem. And some people still don't want to get off their couch and actually work, but that's their problem, at least for now. For us, let's take a closer look at a few charts to help figure out what's coming our way. Today we're going to take a look at three charts, beginning here with the 6-month daily on the spiders, the SPY. And as you can see, things really haven't changed too much since we talked last time. We've got that bottom trend line here and the top of the channel moving through here. So we haven't violated the trend line down here at the bottom by this latest move, but we're getting pretty close. I do see that we've had a number of days in this sell-off. Before, there's only been a few days in this sell-off, so at least that's slightly different. So be careful here. Moving on down into volume, looks fine. Now you can also see here in the MAC that the fast line is coming down a little bit further than it had in previous downtrends, and that's not unexpected, and we talked about that in the latest update. Now, moving down here into the histogram, you can see it there too. Not much has changed there as well. Price rate of change, relative strength index, stochastics, and then Williams look relatively normal, but you can see that even in the Williams we've come down a little bit further and longer than we had in previous times, and I think a little bit of that shows up there in the stochastics and perhaps maybe even in the RSI. But for the most part, things seem to be moving along relatively well. We just got to watch out to see if we do violate this trend line here at the bottom. Let's quickly go to another chart. And the second chart here is the 4-year weekly chart on the spiders, the SPY. And what we were just looking at is this area here with the bottom channel line now running up along the 20 EMA as opposed to the 50 EMA on the daily. And then the top of the channel line running through like that. And that's not necessarily what I wanted to take a look at, but it is interesting because it's pretty steep. So moving on down here into the MAC, this is what I wanted to talk about. From that bottom here in March of 2020, we moved on up, but we now seem to be creating a kind of long-term dome. So we're at this point here, and hopefully it just continues on down in a very gentle arc. But you need to be careful because the risks are a little bit higher in these kind of situations, and the market can break on the downside. We need to watch out for that. We can see this break here. We had a couple of breaks here, but they recovered. Then we had another break there and a break here. And as you know, back in early 2018, as well as in mid-late 2018 and then early 2020, they can be painful when it does break. So be cautious. Move up to the chart one more time, and then a quick look at our third chart. And this last chart here is the 3-year weekly chart on the iShares Russell 2000 ETF, and the symbol is IWM. And from that bottom here in March, you can see that we had a pretty good run all the way up to that point there. But subsequently, we've been running pretty much sideways for the most part. We've cycled through, say, this channel here without too much problem. Some volatility, but I'd rather go sideways than down. As you can see, the MAC was headed down, and we're coming near the zero line, and hopefully we're going to get a reset in the MAC here. And that's what I would like to see for the spiders, is a reset, that arc to move on over very gently without too much volatility in the price chart, and then reset. But it looks like the small caps are going to reset here, so pretty soon you're going to perhaps hear the pundits talking about how the spiders is perhaps coming on down, the S&P 500 coming on down, maybe the Dow. I haven't taken a look at that lately, while the small caps might get a resurgent if there is a bottom and a favorable test of the bottom, the fast line coming down through here, and then maybe on up. So there's a possibility that we can get an uptick in those small caps. And it's also showing here very nice bottoming and basing and then heading on up. And you see that formation as well here in the price rate of change, relative strength, stochastics, and the Williams. Back on up here to the price chart. And one last look at that sideways trading. I don't see too much trouble to that, but I would say soon there is a possibility that we could have a breakout on the upside. So just watch to see if the pundits talk about that. We know it ahead of time. And for today, that's ChewDog Charts. Thank you.